Hello everyone and welcome to Finance at JCL. Today I'm going to run through the latest Boohoo news, in particular with regards to their earnings. Do stay tuned because I'm going to be sharing later in the video my Boohoo position in my investment portfolio and the action that I'm taking off the back of what's going on in the market at the moment. Just a quick one before we get into the detail. I'm actually considering webcam so you can get my face in the corner of the videos. If you think that would add value to the videos and make them a bit more watchable, please drop me a comment below. If you are new here, thanks for joining me. I look at stock reviews, my journey to a £1 million investment portfolio, and some personal finance tips. So the big Boohoo news, we'll have a look at that in a moment. But first of all, if you don't know what Boohoo do, we can just have a nice summary here on Simply Wall Street. They are an online fashion retailer. Their primary market, which 50% of their revenue is the UK, but they are also in the United States, a few European markets, and a few international ones as well. Now, if we look at YouGov, just to get a bit more background on them, you can see here 86% of people have heard of Boohoo. This is sort of UK site, so it's got very wide recognition. And of that, about a quarter of them actually dislike, but there are higher percentages of people that like them and are neutral towards them. If we look at the left-hand side of the screen and the target market of 40 or under, that's well represented here by the popularity lines, less popular amongst the baby boomer generation. Not surprising given that isn't their target market. So what's the news? The news is that within the last few days, the first half of 2022 earnings have been released. Now, there's some good and bad in here. I'm going to dig into that detail just to understand what's going to happen, because there'll be a lot of you out there thinking, well, I'm thinking of buying Boohoo because the market price has dropped, or you might be holding thinking, do I average in, do I just stick, or do I actually sell out because I'm not happy? So I'm going to share some information that will support you in that decision, but do your own research, don't just rely on what I'm saying. So the revenue's up massively in the first half to close to £1 billion in half a year, and that's up 20% from H1 last year. And that's impressive because a lot of that time last year was in full lockdown with most of the shops shut, so they've got a high comparison benchmark, whereas things have been open in the UK for several months now. So the fact that revenue's up 20% is very impressive. Conversely, net income is down significantly, and that could be a cause of concern, so we'll try and understand why that is. Okay, but first of all, let's just have a look at what's actually happened in the market, and that's probably driving what some people are seeing or perhaps feeling. The current share price is just over £2, it's £2.14. You can see here this massive drop off in the last few days. They're well above 250, that 250 to 260 range until this news came out. Now, if we have a look back at what's happened in the last year and a half, pre-virus, they're around sort of £3.20, £3.30, got all the way down to almost £1.50 in that sort of range. It's a good opportunity to buy them then. Very quick recovery to sort of £4, dropped off, but you see the massive volumes here, all the way down to just over £2. I think that's probably when the sort of Leicester factory news came out. Again, a swift recovery up to almost £4 again, dropped back down again, £2.50, all the way up again to 370 in this sort of range, and then they've been on a steady decline and then massive drop off. So you've got the opportunity to get them here at a similar price to when some of the negative news came out last summer. So that's what's happened, and a lot of people, I've seen comments around saying, oh, it's dropped so much, should I sell out, worried about it? Let's have a look at what's going on. I've got here Simply Wall Street, which I recommend as a good platform to get additional information around the companies. And the first thing that jumps out here is around about 46p ratio and a 1.4 price to sales. So that price to sales ratio for a company that just grew revenue at 20%, that seems quite low. The price to earnings ratio seems quite high for a company that is only growing at sort of 20%-ish. So we'll have a bit of a deeper dive into that a bit later on. So I want to have a look at the balance sheet first of all. So there's been a massive drop in this company, but what I want to know is if I'm going to sell, because I do hold stock at the moment, full disclosure, how the fundamentals of the company change. First of all, in their risk in terms of their balance sheet, chance of losing your money, or indeed has their profitability to growth prospects changed? That's the other side. This balance sheet looks very strong, assets higher than liabilities, particularly in the long term, and there's a very small amount of debt. So debt to equity ratio is very low. So looking at this, it looks to me like there's very low chance of this company failing. The cash in short-term investments is 3 times bigger than the debt, so it's absolutely excellent. And the other good thing is there is no dividend, which you'd expect for a company that's growing and is able to reinvest that money into the business effectively. So that's the balance sheet. So what have they been doing? Now look at this revenue growth. If you go back to 2015, 2014, 130 million, it's just going up, up, and up. Looks like it accelerated 2017, and it's just a constant increase here, all the way up to, you can see their financial year or half year to the end of August, annualized revenue of almost 2 billion. Profits, as you can see again, were rising till the recent results. So they've had a very good history, 28% per year historic annual earnings growth. So let's have a look at the forecast. So we're here, and the forecast is continuation of this growth, and both in revenue, and you can see earnings getting up to 156 million there, with revenue at 3.3 billion. That is well over 50% higher than today. The forecast annual earnings growth from 18 analysts for the next 3 years is 28%. Earnings per share, so it peaked there around 7.5 pence, projected here to be 13 pence, and currently a bit lower than that at 5p with recent results. So that is quite a good increase in the earnings per share forecast the next few years. They're not just growing unprofitably. The prediction is from the analysts that there will be increasing levels of earnings, which is very important because in the long run, the share price follows the earnings to a large extent. Another thing I'd like to flag here is this ownership. Look at the insider trading, no sales and plenty of purchases, and that's by multiple different insiders, and actually at prices that are higher than the current market price of £2.14. So that is something to note. And the insiders still own 1/5 of the company, and quite a few of them. And the original co-founder is 13% of that 20%. So what we've got here is management and an owner with skin in the game. So we're going to go into a bit more detail here just to understand why that P ratio is so unattractive. Pick out some key information from their website, from the financial reports. So first of all, even though the market reacted negatively, it is record first half sales of almost £1 billion. You see that's 20% higher than last year, which has got a difficult comparator. So that's impressive, first of all. Gross margin percentage is very, very similar, 0.4 percentage point difference. The other thing to flag, we know the earnings down, the cash is down, and that's due to some acquisitions of Debenhams and other brands here in the UK over the last year. You can also see there's been a lot of capex, so less free cash flow. And they are setting the conditions for success for future growth by getting some new things in place. And there's a lot of increased warehouse and distribution capacity, so they're not going to be trying to grow too quickly. They are very much investing to ensure they can grow successfully. Just some interesting governance highlights here. So they've had a look at what they do for the UK economy. They are going to invest £500 million and create a further 5,000 jobs in the next 5 years. So they've got ambitious plans, and they've got a marketplace for pretty little thing. Looks like a resale platform coming in, and I think that addresses some of the concerns around fast fashion, around are they sustainable and wastage and returns. So I imagine they could set up a platform, take a cut, be another income stream whilst also being sort of sustainable, reducing waste. So that's really good. And what they have noted here is demand is further accelerated in August and in September. And I think what we're looking forward to this year, certainly in the UK, is probably a much more open Halloween and Christmas, and a lot more people out and about, a lot less restrictions. So I think there could be the opportunity there for further positive comparisons compared to last year when a lot less of this was happening. So they're talking full year sales growth 20 to 25%, which is sales growth of 20 to 30% in the second half of the year. So you've got a business here growing at least 20%, say 25%. So that is impressive. We need to find out what that forward PE is as well, because if that's around 20 or less, it could be quite impressive. Now, the negativity came around their EBITDA margins, which are 9 to 9.5%, whereas they previously guided 9.5 to 10, so it's very slightly different. That's caused quite a drop in the share price. Medium-term guidance of sales growth of 25% a year and 10% EBITDA is still unchanged. So let's put long-term investors in main. I want to invest for long term, so this is the sort of thing that I'm looking for. That medium-term guidance is unchanged. Now, if we have a look at this, if any of you hold Corsair Gaming, you would have seen this in terms of international shipping costs. They were hit by that, so they didn't do as well in their earnings. terms of their earnings number. The revenue is great, the earnings wasn't, and that was international shipping costs. You can see here £26 million. That is quite a high number. And if we look at their EBITDA, that's quite an additional wedge added onto that if that hadn't have happened. So that's one of the explanations as to why their current PE ratio isn't as attractive as you might want it to be. Now have a look at performance by market. The UK's 58% revenues. There's 32% growth on last year, 81% on 2 years ago. Very, very impressive. USA's up 24%, 126% 2 years. Where it's got a bit harder is the rest of Europe due to various COVID restrictions and some customs issues. And then rest of the world, that has gone down as well, 16% down. And that is, again, impacted by air freight and shipping times. Overall, the key markets are looking very positive, growing very quickly. There's lots of new warehouse space coming on. Clearly looking at how they grow, and they're now looking at their supply chain in even more detail. They're completed over 1,100 audits of overseas factories. Clearly, also, they've got their Leicester issue that they've been dealing with. So things are definitely moving forward. Management are addressing all the issues that have been raised. And just in terms of KPIs, a lot more active customers and orders compared to the previous comparative period. You can see the exceptional costs. There's extra warehouse costs, there's some one-off redundancy costs, disruption, restructuring due to some of the acquisitions. So we talked about the shipping earlier. So you've got 20 million of exceptional costs there, 26 million of higher freight costs. If you added 46 million back into their results, they're not doing too badly at all. So their forward P ratio is 20. So I think you're looking at a business here that's growing revenue and guiding to grow revenue at 25% a year very consistently. Earnings by many analysts are forecast to grow. There's been a lot of exceptional items which will hopefully or should resolve themselves and be lower going forwards. So this is why the 4P is 20. So a 4P of 20 for a company growing at this rate that is known in the UK by 86% of people, is very well known in its target market. It's growing very well, addressing all the concerns. So for me, this looks like an undervalued growth stock. You don't get too many stocks right at this rate in the UK stock market. So if you're a UK investor, I can see why you'd be attracted potentially to this. I think the risk is very low in terms of business failure. Are they going to drop that much? Will you be able to get this company at a much lower price than they are now? Trying to predict market is perhaps foolish, but I don't think it can get that much lower. So that leads me on to my position. Now I'm going to share my information here on ShareSite, which is a very good portfolio management tool because I've actually got 4 different accounts, brokerage accounts. So you can integrate everything into here. You can load on the big brokers automatically. And it's a nice way to manage the portfolio. So here is my Boohoo history. Start of the year, I bought a little position at £3.34. And then as the market price dropped, I saw opportunities. You can see here at £2.70, £2.54, I purchased additional shares. And that's given me an average of, here we go, cost-based share £2.91. You can see that is lower than my original purchase. So I've reduced my risk by lowering that average and also increased the upside. Now, what I have done, based on my research, based on some reading I've done and stuff we've gone through here, I've put in an order which should hopefully close out Monday morning. And I'm going for another 225 shares. And that will reduce my average from £2.91 to £2.66. And that will reduce my risk of losing money because the stock's got less distance to go to get back to that break-even point, and therefore increases the upside. So that's what I'm doing. If you're interested in ShareSite, I have got a link in the description below if you want to have a look at this platform and to get a small discount when you sign up. It's got really useful information around the sort of average pricing, cost base. You can look at everything that's been done before. I don't mind being down on a position if the company's still growing. I think fundamentally this company's still growing well. There's nothing here that worries me that the basis of why I invested originally has changed. I just got the opportunity to reduce my risk, increase my potential return. So I'm going to take that. To see how Boohoo fits into my overall UK portfolio, which is performing well, click the link on the screen and you can see all of my UK holdings and their performance.